Welcome to another deep dive here on Marginal Thoughts.
Great to be here.
Today, we're jumping into something, well, really fundamental if you're thinking about your money, especially if you're just starting out or maybe just want to get a clearer picture.
Absolutely. It's a cornerstone concept.
You've probably heard phrases, right? Like compound interest is the eighth wonder of the world.
Oh, yeah, that one gets quoted a lot.
Or seen those charts, where money grows like a snowball, just getting bigger and faster.
The classic visual.
What if, understanding this one idea could genuinely shift how you see your own potential for saving, for investing?
It absolutely can. It's powerful stuff.
Well, that's exactly what we're going to try and unpack for you today. We've looked at a whole stack of material to make this clear.
Okay, so let's get right into it then. Compound interest. At its simplest, it's just interest on interest.
Interest on interest. Okay.
Think of it like you put your money to work, right?
Yeah.
And then the money it earns also starts working for you. It's basic, but crucial for personal finance because it lets your savings grow, well, kind of by themselves.
And it's not just steady growth, like adding the same amount each year. There's something different happening.
Exactly. That's the key difference. It's exponential growth, not linear.
Linear versus exponential. Okay.
So here, linear is like walking steady,
Yeah.
same pace, same distance each minute. Exponential is more like getting faster as you go. Compounding makes your money grow faster and faster because the base it's calculated on keeps getting bigger.
The snowball effect. That makes sense now.
That's the perfect image for it.
And that's probably why it gets called, the eighth wonder or a powerful force. Maybe by Einstein, maybe not, but the idea stands.
Right. It really highlights the long-term potential.
Yeah.
But to really appreciate compound interest, it actually helps to look at simple interest first.
Okay, good idea. Lay the foundation. Simple interest. How does that work?
Simple interest is, well, simpler. You only earn interest on your initial investment, the principal,
Just the starting amount.
just the starting amount. So imagine, Kevin, this is based on an example we saw, invest $1,000. Let's say at a 10% interest rate per year.
Okay, $1,000 at 10%.
So with simple interest, he earns $100 every single year, 10% of the original $1,000.
And what does he do with that $100?
In this simple interest scenario, Kevin takes it out, withdraws the $100 each year.
Okay, so he spends the profit, leaves the $1,000 in.
Exactly. So after year one, he's got $100. Year two, another $100. Fast forward 30 years, he's collected $100 30 times.
So $3,000 in interest?
Right. Plus his original $1,000 back. So total $4,000. His money grew, sure, but the amount of growth was the same each year. Flat, linear.
Got it. Steady, predictable, linear. Okay, now the alternative. Compound interest. What happens differently?
Okay, now let's bring in Cindy. Same deal. $1,000 invested, 10% interest rate per year. But here's the crucial bit. She doesn't withdraw the interest. She leaves it in.
Leaves it in the account. Okay.
Precisely. And this is where the magic starts.
Right.
Year one, just like Kevin, she earns $100 interest. Her total is now $1,100. So far, same.
Okay.
Year two. Now she earns 10% interest again, but it's on the new total of $1,100.
Well, not just the original, though.
Exactly. So
Okay.
10% of $1,100 is $110. Her total is now $1,210. See, she earned more interest in the second year.
Yeah, $10 more because the interest started earning interest.
You got it. Year three, she earns 10% on $1,210. That's $121 in interest. Her new total is $3,331 gross. The interest earned each year keeps increasing.
Wow, okay. Because the base keeps growing. The interest payment itself gets bigger every year.
That is exactly the engine of compound growth. And over time, well, the difference is staggering. Remember Kevin with his simple interest. After 30 years, he had $4,000.
Right.
Cindy, just by leaving the interest in after 30 years, has $17,449.
Whoa, $17,000 compared to $4,000.
Yep, over 4 times more. Same starting amount, same rate, just reinvesting the interest. That growth curve isn't a straight line. It swoops upwards, sharply. It really shows why they say time is your absolute best friend with compounding.
That difference is just huge. It really drives home the point. There was another example, wasn't there? Something kind of out there, but just to show the speed.
Yeah, the doubling example. Totally unrealistic for investing, but great for illustrating the concept. Imagine you start with just $1 and somehow you double your money every single day.
Okay, $1 becomes $2.
Do one. $1. Day two, $2. Day three, $4. Day four, $8. You see the pattern.
Yeah, doubling each day.
So the question is, how many days would it take, starting with that single dollar, to reach $1 million?
Oh man, doubling every day, I don't know, months, a year. longer.
Feels like it should take ages, right? The answer is 21 days.
21 days. Seriously, from $1 to $1 million.
Seriously. Now, obviously, you can't get returns like that in the real world, but it powerfully shows how exponential growth just explodes once it gets going.
That's incredible. A really vivid illustration. Okay, so putting aside magic doubling, what are the real world's levers? What actually determines how much your money compounds?
Right. So the sources basically point to three key things. The interest rate, the principal that's your starting amount, and time.
Rate, principal, time.
Okay. The interest rate, pretty intuitive. Higher rate generally means faster growth, but, and it's a big but, higher potential returns usually mean taking on more investment risk. So there's a trade-off.
Makes sense. What about the principal?
The principal. How much you start with definitely matters. A bigger starting pot means more dollars earning interest from day one.
Right.
But, and this is maybe the most crucial takeaway for many people, time. Time is often the most powerful factor of the three, especially over, decades.
More powerful than starting with a big chunk of money. How does that work?
Well, let's use Cindy's numbers again. She got to roughly $17,500 in 30 years, starting with $1,000 at 10%. Now, what if you wanted that same $17,500, but you only had 20 years to get there?
Okay, 10 fewer years.
You couldn't just start with a bit more. You need to start with about $2,600. That's 2.6 times the initial principal.
Wow.
And if you only had 10 years, to get that same result, you'd need to start with around $6,700, almost 7 times the initial amount.
That really highlights the advantage of starting early, doesn't it? Even if it's with smaller amounts. Decades make a huge difference.
Huge. Time lets that exponential curve really do its thing. So if you're younger, time is just this incredible asset. If you're starting later in life, investing more can help bridge the gap. But starting something consistently, even small amounts, still lets compounding work for you over whatever time you have left.
Okay, so this power, it's not just for money sitting in a bank account, right? Where else does this apply?
Oh, absolutely not. It applies basically anywhere you get a return and can reinvest those earnings. So think stocks, bonds, mutual funds, ETFs.
As long as the earnings go back in.
As long as the earning, whether that's dividends, interest payments, or growth in the investment's value, are put back to work to earn more returns. That's the key.
Understanding this also kind of changes how you think about everyday spending, doesn't it? That whole idea of delayed gratification.
It really does. It shines a light on the opportunity cost. What you could have had if you invested the money instead of spending it. Some sources used examples like
the daily coffee.
Exactly, that $5 coffee you grab. If you consistently invested that $5 instead, say at that same 10% compounding rate we used over 30 years, that one $5 purchase could potentially grow to around $80.
$80 for one coffee you didn't buy 30 years ago?
Potentially, yeah. Or a $10 lunch. Same scenario, could be worth almost $160 in 30 years.
Okay, that's for single purchases. But what if it's a habit, like every week?
That's where it gets really eye-opening. A weekly $5 coffee habit is $260 a year. Invested at 10% compounding over 30 years, that could become over $4,100.
$4,000 from skipping one coffee a week.
Or that weekly $10 lunch habit, $520 a year, that could grow to over $8,200 in 30 years. Now, the point isn't necessarily never buy coffee again. It's more about awareness. Knowing the potential future value helps you make conscious choices about where your money goes spending now versus investing for later.
Right. It's about informed decisions, not deprivation. Okay, so awareness is key. Another thing that affects the final outcome. Fees. They often sound small, like 1% or 2%. Do they matter much?
Oh, they matter hugely. Because fees also compound, but they work against you. They reduce the amount of money you have working for you.
So it's like reverse compounding.
Exactly.
Yeah.
A small percentage taken out each year might seem trivial, but over decades, it really eats into your returns. Let's revisit Cindy and her $17,449 goal after 30 years, assuming zero fees.
Okay.
Now let's add a small fee, say a 0.2% annual management fee. That's pretty low, typical for some index funds that just try to match a market index like the S&P 500.
Right.
With that fee, after 30 years, she'd end up with about 94% of the fee-free amount. Still pretty close.
Okay. A small drag, but not catastrophic.
Right. But now, let's say she was in a fund with a 2% annual fee. That's more common for some actively managed mutual funds where a manager's trying to beat the market.
2% still sounds pretty small. You keep 98%, right?
That's how it sounds.
Yeah.
But remember compounding. After 30 years with a 2% annual fee, Cindy wouldn't have $17,449. She'd have only about 56% of that amount.
Wait, 56%? So a 2% fee over 30 years cuts your potential wealth almost in half.
Roughly, yes. That 2% comes out year after year, reducing the base your money grows on.
Ah,
It's a massive difference long term. You thought you were keeping 98%, but the compounding effect on the fee means you kept just over half the potential growth. Sources mention different fund types often have different fee structures. Index funds generally lower, actively managed funds often higher, and things like hedge funds can be much higher still.
is a higher fee ever worth paying then?
Well, according to the material, the justification for a higher fee is if the fund manager consistently delivers returns that are significantly better than a benchmark index, even after you subtract their fee.
So they have to earn back their fee and then some consistently.
Exactly. The issue highlighted was that many actively managed funds actually don't consistently beat their benchmarks after fees. So in those cases, the higher fee just acts as a major drag on your long-term wealth compared to a lower cost option like an index fund. It really comes down to performance versus cost.
Okay, so the math of compounding is powerful, and fees can seriously erode it. But some sources also brought up reasons why maybe achieving that kind of to-the-moon growth isn't always straightforward for everyone in the real world.
Yes, it's really important to layer in that real-world context. The theory is one thing, but practical factors matter. One concept discussed was life cycle savings.
Life cycle savings. What's that?
The idea is most people don't just save and accumulate wealth nonstop forever. You typically have distinct phases. There's often a period early on, maybe dealing with student debt or low starting salaries. Then your working years, where hopefully you can save and invest.
What's the accumulation phase?
But then comes retirement. And in retirement, you usually start drawing down those savings to live on. Plus, you might face higher healthcare costs or end-of-life expenses.
So the graph isn't always just up and to the right.
For many people, no. It might rise during their working lives, but then it plateaus and starts to decline in retirement. Some analyses suggested that many families might actually end up exhausting most of their accumulated wealth by the end of their lives. So this view frames saving less as a path to infinite riches and more as a necessary step to fund survival and retirement.
That's a more sobering perspective than just the exponential curves.
It is. And related to that, another major challenge brought up was simply the difficulty many people have saving at all.
Just affording to put money aside.
Exactly. With the cost of essentials like housing, energy, food rising, for a significant chunk of the population, there's just very little or even nothing left over at the end of the month to actually invest and get compounding started. This obviously impacts their ability to save for retirement or build any wealth.
And there were broader economic points raised too, about who benefits most.
Yes, some sources discussed wider economic trends. For instance, the idea was presented that as economies mature, exponential growth for everyone becomes harder. Finite resources, a finite planet, limits emerge.
Okay.
And in that environment, one argument presented was that those who already have significant wealth can continue to grow their wealth at rates often higher than the overall economy, perhaps by acquiring existing assets, land, property, companies, rather than just funding new production.
So buying up things that already exist.
That was the perspective offered. This source described it as potentially leading to increased concentration of asset ownership, making it harder for ordinary families who don't already own significant assets to get onto the ladder and benefit from that long-term appreciation and compounding. It was framed as a dynamic where asset prices get bid up, potentially making asset ownership less accessible over time for middle and lower income groups. There was even an analogy used, comparing it to Esau trading his long-term birthright for immediate food.
Okay, so these are arguments about how the system itself might make compounding harder for some than others. And did these sources propose solutions?
The source raising those particular points about asset concentration did suggest potential policy changes, specifically mentioning shifts in the tax system, potentially taxing ordinary income less, and wealth or capital gains for the very wealthy more as a way to try and counteract that dynamic and reduce inequality. But importantly, these are specific viewpoints and proposed solutions presented within the source material we reviewed.
Right, understood. We're reporting on the perspectives discussed. Okay, so pulling all this together, we have the incredible power of compounding math, but also these real-world hurdles like fees, life stages, the ability to save, and these bigger economic questions. What's the main takeaway for someone listening, especially if they're newer to this?
I think the core message is twofold. First, yes, compound interest is genuinely powerful. Understanding it and leveraging it by starting early, being consistent, and reinvesting earnings is a proven path to building wealth over time. Grasping that basic mechanism is absolutely fundamental for making smart choices with your money.
Don't lose sight of that core power.
Exactly. But second, keep it grounded in reality.
Yeah.
Be acutely aware of how things like fees silently erode your growth over decades. Understand that saving often follows a life cycle. It's not always a straight lineup. And acknowledge the real challenge many face in just finding money to save consistently within the current economic landscape.
So it's about harnessing the power while navigating the realities.
Precisely. It gives you a much more complete and, frankly, more useful picture for planning your own financial journey. It's about making informed decisions with the resources and time you have within the world as it is.
That really helps frame it. Okay, a final thought then. Considering both that incredible potential of compounding and all these real-world challenges and perspectives we've touched on, how might really internalizing this deep dive change how you, the listener, think about your long-term savings goals or the investments you consider, or maybe even how you interpret some of the economic trends you see playing out?
Yeah, definitely gives you a different lens to look through.
That's our deep dive for today. We really hope this exploration of compound interest, with all its facets, gave you some valuable insights, maybe sparked some new thinking, especially if this was new territory for you.
Hope it was useful.
What stood out to you most from our discussion today? Let us know your thoughts. And of course, if you found this valuable, please subscribe to Marginal Thoughts. We'll be back soon with another deep dive into fascinating topics.